Hello and welcome to our practice exercise for adjusting journal entries. In this journal entry exercise, we are going to be talking about two methods to record adjusting journal entries. So what I want to mention here is, as you'll see in just a bit when we get to the journal entries, we have the two different sections, and one is for the standard method and one is for the alternative methods. So you will want to take a look and see whichever problem you're working out of the textbook or whatever you're dealing with in real life for adjusting journal entries. You'll want to know what method you're going to be using, and you can follow that particular column. So just pay close attention to which column we're putting them under. Now, I want to read through this intro because that kind of gives you an idea what the standard versus alternative method is. So the standard method of recording adjusting journal entries is where when you first buy something that's a prepaid expense, you record it all as an asset, and then the adjusting entry is when you use a piece of that asset up. So that would be the standard method. For unearned revenues, you record those initially as liabilities, the entire amount, and then when you use it up, you move a little bit of that liability over to revenue. The alternative method, basically, you instead of recording anything as an asset first, you instead record it all as an expense for a prepaid expense, and then at the end for the adjusting entry, you back out the portion that you have not used. You move that back to an asset. So in the end, the balances are the same. It's just a question of what do you start with and what's your adjusting journal entry look like. For the unearned revenues, you'd start by recording them all as revenues, and then you'd back out the portion that really had not been earned by the end of the period. So the other thing about adjusting entries is there is always the adjusting entry itself, and then there's the related cash entry. For the prepaids and the basically the deferrals or reclassifications is another term for them. That would include your prepaid expenses or your unearned revenues. For those, the first entry is the cash entry when you bought the prepaid asset or when you received the cash for the unearned revenue. That's the first entry, but that's not an adjusting entry. The adjusting entry happens at the end of the period when you realize that, hey, we used up some of these supplies, for example, or we earned some of this revenue. For the accruals, however, the first entry is the adjusting entry. You're trying to accrue for expense or accrue for revenue even though you have not yet received the cash. So that's the difference. With the accruals later on, you'll have the cash entry. That's the subsequent entry. So the reason I'm explaining that is that with this exercise, we're not only going to be dealing with the actual adjusting entry, we're also dealing with the cash entry. It's important to know the difference between the two. So up here we have a list of all of these different transactions. They're your common adjusting entries: supplies, salaries, expense, prepaid insurance, unearned revenue, all of that. But I have them listed down here above each journal entry as well. So we'll go ahead and go through them in that way. It might make a little bit more sense. So A, each Friday, Mitzi Incorporated pays its employees for the current week's work. This includes a $10,000 payroll for all 5 days. This year, December 31st falls on a Tuesday, and the next payroll will be January 3rd. So we are concerned with basically Monday and Tuesday. We're trying to accrue for the salary expense, and we have to record 2 days of it, Monday and Tuesday. The next payroll will be Friday, January 3rd. So our first entry, since it's an accrual entry, is going to be the accrued expense, essentially. So we would debit salaries expense. Now notice the amount. $10,000 for 5 days. That means $2,000 per day, and we need 2 days of it. So $4,000 is what we're accruing here. The accrual entry is a debit to salaries expense, credit to salaries payable for $4,000. Now with these accruals, there is no alternate method, so it's the exact same. The only type of adjusting entry that has the alternate method would be your 2 reclassifications or your 2 deferrals. That being said, we still have to worry about the subsequent entry. Now, this is not the adjusting journal entry. This is the cash that comes after the adjusting journal entry. So with this, what we're basically saying is we're now on Friday, January 3rd. We need to record total payroll of $10,000. We're paying cash of $10,000, but we've already set up one of the expenses for $4,000. We now need to set up the other expense for the other $6,000. Now, we know we're going to pay $10,000, so what we have to do is pay this salaries payable off. We debit it for the other $4,000, and that allows us to credit cash for $10,000. Now, again, there is no alternate method. It's the exact same for the accruals. So we could just put NA, but we're just going to type it in. Exact same. Now we get into our first prepaid. Again, it's referred to as a reclassification or a deferral, whatever term you want to use. So there we are buying insurance. So this is a cash entry. It's not really the adjusting entry. Now, under the traditional method, we would set up the asset for prepaid insurance. So we would debit prepaid insurance to set up this asset. Now, the amount is $24,000 that we purchased. And, of course, we're paying cash. In the amount of $24,000. So that's the traditional entry for this. If we were using the alternative method, instead of setting it up as prepaid insurance and then eventually using it, we assume, basically, that we're using it all this period. So we debit insurance expense and credit cash for that $24,000. Now, one way or the other, regardless of whether we start off with the asset and move it to the expense, or start off with the expense and move it back to the asset, the amount we haven't used, the end result has to be the same. We're going to end up the period with only the amount we've used in expense and the amount that's unused in prepaid insurance. So let's think about this now. We're now dealing with the actual insurance expense. Later on, we've actually used it. Now, we're talking about, and you want to read these questions very carefully because we bought this on July, and let's say we're at the end of December, so we have to record those months of insurance expense. So July through December, we're talking 6 months of insurance. So what we're saying is assume we have not been making adjusting journal entries on a monthly basis. In that case, we're going to make 6 months of it right now, 6 out of 12. This was a 12-month policy. We're using up half of it, 6 out of 12. So you have to take a look at what method you used to initially record it and do the proper entry to get everything to balance, basically, to get everything to the proper balance. So if we set everything up as a prepaid insurance asset, then at the end of the period, we have to move some over to insurance expense. So here, we're going to debit insurance expense for the amount we have used, which is half of $24,000, and we're going to credit the amount that was started off as an asset, and now we're moving it, we're reducing it down to the proper balance. So we're debiting insurance expense to add that into insurance expense. We're crediting prepaid insurance, the asset, to reduce that. So that's where we get that amount. But with the other approach, where we initially reported everything as insurance expense, we actually need to move some over to prepaid insurance, basically the amount that had not been used, which in this case is still half. So $12,000 had not been used, so we're moving that into the prepaid insurance because there wasn't anything to start with under this method. And that means we have to reduce insurance expense because we didn't really use it all. So we're crediting insurance expense to reduce it. $12,000. That's one of the odd situations where you end up crediting an expense. E, Mitzi purchased $7,500 worth of supplies during the year. So again, this is a deferred. It's just like the insurance situation. So we have the standard method and the alternative method. So here we're going to record the purchase of supplies by debiting the asset, and it's $7,500. And of course, we're crediting cash. Again, this is not the adjusting journal entry. This is your cash entry. So you can imagine the amounts are going to be the same over here, but the entries are not. Under this method, we assume we're using all of the supplies, so we debit the supplies expense for the entire amount up front, and of course we're still crediting cash. But even though we're assuming we used them all, chances are we probably didn't, so we'll have to reverse some of that. But let's say we did record everything as supplies to start with. We started the year with $3,750 in supplies. We know we added $7,500, but we only have $225 left. So the journal entry there would be, we have to take the $3,750 starting balance plus $7,500 that we purchased. So that's the amount we have that we could have used, but we did not use the $225, so we subtract that out. And that tells us we really did use $90.25. Now, since we started in the supplies account, we need to move some into supplies expense by debiting supplies expense. And we're going to credit supplies to reduce it. Now over into this other method, we started with everything in supplies expense, but it really should not have been supplies expense. Not all of it. Instead, we only report the amount that is left over as the asset. So the alternative method for this one is a little bit unusual. You have to kind of think through this. If we're using the method where we record everything as supplies expense first, and then at the end of the period we only back out the portion that was not expensed, then what that basically means is, hey, we would have already reported $3,750 in supplies expense in some previous entry, and then now we just recorded $7,500 in supplies expense. So what we need to do with this journal entry is basically move the portion left in supplies back to supplies and out of supplies expense. We just said only $22.25 is left in supplies, so that's the amount we need to move. Everything else that was recorded in an expense stays there because it was valid expense. So here we are debiting supplies to add it into supplies, and we're crediting supplies expense to move it out of there. This amount was not used up, so we have to adjust it out of supplies expense. So the next adjusting entry is in December. This company completed $10,100 worth of work for the company, for the customer. The company policy is to bill for the work on the 15th of the following month. So this is an accrual entry. We're accruing revenue. And what we do there, they haven't billed yet, and they certainly haven't collected, so no entry has been recorded. We need to debit accounts receivable to show that we're going to receive it, and we're going to credit revenue. It's an accrued revenue, but it's just the revenue account for the $10,100 reported. Remember, the accruals don't have an alternate method, so it's the exact same. Now, the subsequent entry, the cash, when the transaction is finally completed on January 15th of the next year, the thing with this is that we've already set up the billing, essentially. This is the entry that we would record if we had billed it. So H is kind of a trick question. There's really nothing more to do. We would have done the exact same thing, and we already did it. We already debited accounts receivable, credited revenue. That's the exact same thing we would have done. So now I'm just going to select, I added a no entry option. You can type it in or you can leave it blank, but I just put in a no entry option. Now, what subsequent entry is needed when the cash is finally collected? There we will need an entry. So we're going to be collecting cash, of course. So we'll debit cash and we'll credit accounts receivable just like any other payment that we receive. Nothing really all that special with this entry. The alternative entry is the exact same. With the accruals, you don't have to worry about a difference between the two. Early in the year, Mitzi collected $25,000 of work that was expected to be completed midway through the next year. What journal entry is needed for this transaction? So this is your unearned revenue. The first entry is a cash entry. We've collected $25,000 in cash, but we can't count it as revenue yet. Instead, it's unearned revenue or deferred revenue. Now, under the alternative method, we still collect cash, we still debit cash, but now we're basically assuming it's all revenue right off the bat, and then we'll figure out later on what portion we really haven't earned, and we'll back it out. So now, okay, assume that by the year end, 10,000 of the above work was completed. So with the first method, we're going to debit unearned revenue to reduce it. We're reducing that liability for that $10,000. And we're crediting actual revenue for the amount we've earned, $10,000. Under the alternative method, we reported everything as revenue first, but we have to back out the portion we really haven't earned. So we're debiting revenue to reduce it because we didn't really earn all of it. In fact, we did not earn 15,000 of it. If we earned 10, that means there's 15,000 left. Now, what we do there is we put that $15,000 in unearned revenue. That's where the liability belongs. And that's what the remaining balance of unearned revenue would have been over here. 25 minus 10 would have been $15,000. Now we're just putting it into unearned revenue. So just two different ways of looking at it. Now we have all of the work completed early in the next year. So what journal entry would be needed for this transaction? In this case, we've already recorded 10,000 of the revenue. By the way, we've already collected the cash. So we're basically saying all of this has now been earned. So we need to debit unearned revenue for the rest of it to reduce it out to zero. There was 15,000 left that was in unearned revenue, and now it's earned. So we reduce this, and we credit revenue for the remaining 15,000. Now what we're doing here for the alternative method, we already have recorded, we ended up recording 10,000 of revenue, and we put the 15,000 back into unearned revenue. But now our adjusting entry or our subsequent entry is the exact same as the other method. We have to debit unearned revenue for 15,000 and move it to revenue because now we've actually earned it. Entry M. Depreciation for this year totals $17,500. So a depreciation entry is always going to be a debit to depreciation expense for that amount, and a credit to accumulated depreciation. Now notice, that's the odd thing about depreciation journal entries. We don't credit the asset to reduce it. Instead, we credit a contra asset, accumulated depreciation. Now, we did not record the purchase of this asset, so we're going to actually record this the same way under the alternative method. And then we have the last two entries related to the adjusting entry of accrued expense. So we've incurred $1,250 of interest expense out of a $1,750 interest payment that'll be made the next year. So it's an accrual. We're debiting interest expense to increase it, crediting interest payable to increase that as well. That's the liability. The alternative method is the exact same. As I said before, accruals have no difference for the alternative method. It's just the deferrals and reclassifications. So now, we need to record the necessary subsequent entry for the above transaction. Now we're basically recording the rest of the interest expense of $500. We debit interest expense for $500 more, but now we have to reduce the interest payable that we set up because we're actually going to pay it now, and we're paying the entire $1,750 of interest in general. So we're crediting cash to reduce our cash account because we're paying it. The alternative entry would be the exact same, just like any other accrual. And that takes us through each of the four types of adjusting journal entries, a few examples for each, for both the original standard method and the alternative method. Hopefully this has helped to clarify how to handle these. And again, when you're dealing with your problems out of a textbook or whatever, you just need to read closely. First of all, you need to identify what method are you using. So read the text question, or just read your company policy if that's what you're talking about, and determine which method do you use. How do you normally record adjusting journal entries, and then be consistent throughout all of them. So thank you for your time, and I will talk to you in the later lectures.